What is a 1031 exchange? Stick around and I'll tell you. Simply put, a 1031 is a tax law that allows an investor to avoid any capital gains on the sale of a property so long as they trade those gains into another property. So for instance, if you bought a property for $2 million and then later sold that property, say 5 years down the road for $2.5 million, well, you've just gained $500,000 in gain. If you enroll that property in a 1031 exchange, that $500,000 is exempt from any tax, so long as you take that $500,000, combo it with any equity that you have in the property, and roll it into the purchase of another property. Ideally, you're adding more units and more scale when you do this. Many people tend to start small, so with a condo that you rent out or a duplex, and then as those are growing in value, you trade up. So you're able to move into a 4-unit or a 5-unit, 10-unit building, and on and on and on. There's no limit to how many times or how frequently you can use a 1031 exchange. Although you may have profit on each swap, as long as you exchange it into another property, you're not subject to the tax on that profit. Then, if it works out as planned, you only pay tax one time, and that's when you liquidate your entire real estate empire. And that tax is actually at a long-term capital gains tax as well. In addition, you will most likely need to use a qualified intermediary who actually conducts the 1031 exchange for you. They take those proceeds and the funds and then place them for you in your new property. You, as the owner or investor, are not allowed to touch these funds. If you do, or if those funds come back to you, you may disqualify yourself from the 1031 exchange benefits. There are also time limits that you must comply with in order to benefit from this tax law. The first timeline is 45 days from the day that you sell your property. You must identify a property that you wish to buy, and you need to do that in writing to your qualified intermediary. The IRS says that you can identify 3 properties so long as you close on one of them. The second timing rule is that you must close on your new property within 180 days from the time you sold your last property. Finally, while these benefits are incredible, I'm only speaking in theory here. You need to talk to a tax advisor to really dive in and fully establish if your investment can qualify for a 1031 exchange. Thanks for listening. If you have any questions, please leave them in the comments below. Like the video if you found value here. Subscribe to the channel for more investing information. Thank you.